So the whole time rates are going up, what's happening to the bond portfolio at Silicon Valley Bank? It's going down in value. There are huge unrealized losses in the billions of dollars. So why wasn't the bank, kind of out of business, 6 months ago or a year ago?
Recently, in an interview with Julia LaRoche, author and economist Jim Rickards gave his take on the current banking crisis. Rickards says that the downfall of Silicon Valley Bank was primarily due to the bank's own gross negligence, even after Goldman Sachs stepped in and offered to raise $2.5 billion for SVB. A severe lack of readiness or any form of proper risk management on behalf of SVB caused any chance for a deal to collapse. Many pundits and analysts are suggesting that SVB's collapse is mainly affecting startups and some of the bigger tech companies, but Rickards believes that this goes way deeper than any of us thinks, which gives more incentive for the government to step in. Let's listen to Jim.
Silicon Valley Bank, okay, what did they do? Well, they did every banker since the Middle Ages has made the same mistake. You borrow short, lend long. So they took in deposits, over $100 billion in deposits. Like, what do you do with the money? A lot of it was loaned to their clients, these tech startups, mostly Silicon Valley, but not exclusively. There's a lot in Massachusetts, some internationally, et cetera. But it was kind of like the other way around. Like, I'll make you the loan, but when I make you the loan, I want you to put it in my bank. So the two sides of the balance sheet, the loan is to the tech startup, but then they put the money in the bank. And so the depositor is also the tech startup, not exclusively. And these are not all startups, by the way. Some of these are, Vox and Roku, and some of these are, mature, successful companies. And they had, in some cases, $2, $3, $5 billion in the bank. And so they used to play to the balance sheet. But in addition to making loans, that was only about half the portfolio. The rest of it they put into government securities, U.S. Treasury securities, and not just Treasury securities, but the long end, 30-year bonds, not exclusively, but heavy on 30-year bonds. So they got all these bonds, and they're making spreads, and it's leveraged, and the returns on equity are, huge, and they're partying. I mean, they're taking all this money and going on, staff ski vacations and all this stuff. I've seen it all before on Wall Street. This is not a new story. But you say, well, what happens when interest rates go up? Well, bond math 101 is, if rates go up, the value goes down. Rates go down, the value goes up. It's a little counterintuitive, but it's really simple. The value moves inversely to the rates. Well, March 2022, what happens? Jay Powell starts raising interest rates, and he kept going through 8 meetings. They're up to 4 3/4 today. Another meeting coming up in about 10 days. My expectation, my forecast is going to raise another 25 basis points. And let's come back and talk about that, because the Fed's between a rock and a hard place, but I'll talk a little bit more about that. So get it up to 5%. So the whole time rates are going up, what's happening to the bond portfolio at Silicon Valley Bank? It's going down in value. There are huge unrealized losses in the billions of dollars. So why wasn't the bank, kind of out of business, 6 months ago or a year ago? Well, the answer is they parked most of these bonds, not all of them, but 2/3 of them, in something called hold to maturity, or HTM account. And that means, this is all legitimate accounting. That means you don't have to mark to market. You are exempt, or you have an exception to the mark to market rule. So if you paid $100 million for the bonds and it's only worth $80 million because interest rates went up, you carried on your balance sheet at $100 million. You don't have to mark down to the 80. So you have a $20 billion, in my example, you have a $20 billion unrealized loss, but you don't have to do anything about it because you don't mark to market. And so, and hey, we'll hold them for 30 years and get paid off and mature and we get all our money back. What's the problem? Well, the problem is you're relying on the deposits staying where they are. And by the way, it's come to light that Silicon Valley Bank in their loan agreement said, when we lend you this money, you have to put it in Silicon Valley Bank, and you may not put it in any other bank. I mean, one of the ways, as a depositor, one of the ways you diversify risk is, take the money and put it in 5 banks. A little more paperwork, but if one of these banks goes down, I've still got the other 4. I'm good to go. But the borrowers had to put it all in Silicon Valley Bank, so everybody's locked in. But the deposits were fleeing long before that. So there was some leakage. Moody's was saying, we're going to downgrade you, but that was not announced publicly. The mark-to-market losses were there, but that was not announced publicly. They brought in Goldman Sachs to try to raise capital. So they had a plan. So as the deposits are fleeing, now they have to sell the bonds to get the cash to pay the depositors. So that whole thing about don't mark to market, hold to maturity, you don't have to mark to market. Well, that's true if you're holding them. But the minute you have to sell it to pay off depositors, you take the hit then and there. There's no more deferral of that hit. So they were having to do that. So Goldman Sachs said, okay, here's the plan. Sell the bonds, sell some extra bonds, sell some additional bonds, reinvest them in higher yielding bonds. That'll satisfy Moody's. You'll still get a downgrade, but it won't be severe. And we'll raise $2.5 billion for you. So they were taking a $1.8 billion hit, and that had to be announced because they're a public company and they're regulated. But Goldman says, we'll go raise $2.5 billion. That'll fill the hole in the balance sheet, make you stable, et cetera. And they got a $500 million circle from General Atlantic. It's a very large, prominent Connecticut-based venture capital private equity fund. They were going to do $500 million. And then Goldman was working the phone, was trying to get the rest. What happened was, as soon as they announced the loss and Moody's did the downgrade, you should have been ready to close the deal right then, like the next day. It's like, okay, and by the way, here's the $2.5 billion. They didn't. And then there's a lot of, there's the market risk we described, but there's just a lot of gross incompetence at Silicon Valley Bank. They had, we're talking about risk management right now. They had a vacancy in the risk management officer. There was like 6 months or more. Nobody was in the position. They weren't thinking about it. And then at least, and there were some good lawyers, and Sullivan and Cromwell, they represent Goldman Sachs. There was some good lawyers involved, but Silicon Valley wasn't even ready to sign NDAs. Like the potential investors were like, okay, we'll take a look, sign this NDA and give us all your books and records. And by the way, this is hairy, so it's going to take a couple days. Why wasn't all that done, a week prior or longer? And why wasn't SVB able to get their lawyers to stay up all night and do the non-disclosure agreements? So they bungled it. They lost the opportunity. And then, Peter Thiel says, get all your money out, and other VCs. I'm not blaming Peter Thiel. That was actually a very smart thing to say. But then it was just over before Goldman could get the deal done. Government takes it over on Friday night. So they came up with this new bail-in philosophy in 2014, but it had never been tested. It had never been used. This was the first time that a government agency, in this case the FDIC, said, yeah, bail-in is the new law of the land, and we're gonna whack the depositors to make up for the losses. Well, that lasted exactly 48 hours till Sunday night. So here you have a 9-year rule. Oh, we're no more bailouts. Boom, within 48 hours, they flip and they do the biggest bailout in history. So they have no credibility. The FDIC fund is going to be seriously depleted. The idea that the taxpayers don't have to pay is nonsense. Why? Because you're going to deplete, since you took away the $250,000 ceiling on deposits, you're going to deplete the FDIC fund, the insurance fund, to pay off all these claims to, Roku and Vox and all these people. So how are you going to replenish the fund? Well, they're going to increase the insurance premiums on the banks. Okay, well, the banks are going to pay that, but where are they going to get reimbursed? Well, they're going to charge the customers fees, or they're going to pay you less interest. In other words, it comes out of the pockets of everyday Americans no matter what you do. You can launder through the FDIC and the bank insurance premiums, but at the end of the day, the banks are going to charge the customers, and so you're paying for it at the end of the day.
To watch the full interview, check out the link below. Do you agree with what Jim is saying here? Do you think the Fed is hiding something and that this crisis goes way deeper than we're being led to believe? Let us know in the comments. If you want to see more on the world of crypto and tech, make sure to like, subscribe, and hit that notification bell as we put out daily content. Thanks for watching, and we'll see you next time.